Welcome back. Still watching Business Morning. Now for commodities market updates, we have Dr. Desola Shimoni, Senior Analyst, Financial Derivatives Company. Great to have you, Desola. Good morning.
Good morning, Ladi. Thank you for having me on the show.
Great to have you. So it's definitely a rate setting season. And back here in Nigeria, we've had that 50 basis points hike. How are you reading this?
Thank you for that question, Ladi. Like you said, it's rate setting season. More than 12 central banks globally had their rate meeting this week, with majority of them hiking their benchmark interest rates. In Nigeria, we saw 50 basis points, which is the sixth consecutive time the Monetary Policy Committee has increased benchmark interest rates this tightening cycle that is starting around mid last year. To now, our benchmark interest rate is about 18%. We've increased benchmark. We've increased the interest rates by around 650 basis points. Now, this came largely as expected. We forecasted a 50 basis points increase with 60% probability or hold. Now, it's important to understand that this 50 basis points is the smallest increase we have seen in this tightening cycle. Previously, we've seen 100 basis points, but this was 50 basis points, which could suggest, the beginning of the end of the tightening cycle. And also, this tracks actions globally, monetary policy actions globally. It's also important to note that inflation has still remained stubbornly high at 21.9% for February, increasing just marginally by 0.09%.
And obviously, looking at inflation for February, one wonders, when do you think the rate hikes will, by the MPC, will have an impact, on inflation, to the downside?
Okay, so typically there's a lag between when monetary policy benchmark interest rates are hiked and when we see the effect on the real economy, and also that depends also on the transmission mechanism, how strong the transmission mechanism is. In Nigeria, I have some questions about the transmission mechanism, but with this Naira redesign program, we've seen quite a lot of money outside the banking sector move into the banking sector. So that could help increase the efficiency or the effectiveness of monetary policy in driving inflation down. But also we need to look at the other drivers of inflation, right? Apart from the monetary factors, some of the key drivers of inflation are non-monetary factors, which monetary policy has no effect over. For example, insecurity issues in major plant growing regions. There's no way monetary policy has very little effect or even no effect at all on insecurity issues. Issues like cost of transportation, high cost of diesel, and even legacy infrastructure issues. All those issues, monetary policy do not have any significant effect on. But I think that with more of the cash now within the banking system, I think we may begin to see some effect on inflation towards the downside. Also, basic effects are likely to kick in now, so I expect that inflation for the next couple of months will begin to trend downwards.
And yeah, we got the 25 basis points by the U.S. Fed yesterday. Some have tagged it a dovish, hike. How do you think? Do you think the 25 basis points would be it, for now, if not for the banking crisis in the U.S.?
So right now, I would not want to be Jerome Powell, right? Because he is in a very, very precarious position, trying to balance two of the key main functions of monetary policy. One is price stability, and the other one is financial sector stability, right? So in terms of price stability, inflation also in the US has been stubbornly high, and many people are raising the question that, since we've seen the most aggressive or the quickest pace of rate hikes in the US, the quickest pace we've seen in, I think, 40 years in the US, yet we are not seeing any big impact on inflation, and this is for a country that has better transmission mechanisms. I think one of the factors for that was during the pandemic, the economy was awash with cash. Like if you had a kid in the US, you get $1,200 as some form of social protection. So households still had a huge savings from the pandemic. Then there was also the fiscal policy. There was also quantitative easing. So all of those are still on ground, and that is part of why monetary policy in the US has not really affected inflation as much as they would like. And as I mentioned, for a country whose inflation target is 2%, having inflation at 6% is giving everyone, especially the monetary authorities, sleepless nights. Now bring into the mix the banking sector crisis, with about 3 medium-sized banks are going under in the United States. I think what they've done is the best they can do in the situation, also to inspire market confidence that our regulatory and oversight functions are still working as they should. The banks are stress tested and they're passing this test. And an investigation also has gone into why SWV failed, why those banks in the US failed, and what went wrong. Why wasn't it flagged in the regulatory oversight functions of the US Fed? But I think what they've done is the best they could do. 2 weeks before now, we're expecting a 50 basis points increase in benchmark interest rate to tackle inflation. But at this moment, I think 50 basis points would have caused the markets to panic. I think 25 basis points was just the right balance of not signaling to the market that we are still addressing monetary policy, while also we are still 25 basis points, I think, was a right balance of signaling to the markets that the US Fed is still focusing on achieving price stability, while also inspiring confidence in the structures in place, that the regulatory and supervisory functions of the US Fed.
All right, looking at currency reaction now, do you think the US dollar liked the 25 basis points? Because I believe I checked it this morning, it was down.
No. So what is happening is, globally, also because of this banking crisis, because of the hikes in benchmark interest rates in the US, and as well globally, we are seeing a risk of sentiment in the global markets. Particularly, we have seen investors dump risk assets and moving to safety. That's why we are seeing the US dollar depreciate, lose against a basket of currencies, particularly Asian currencies.
And obviously, that's feeding into oil prices. See, oil prices are down today after about 3 sessions of gain. I thought this was the one, that would take, oil prices higher, but it looks like it's going to be different.
I think for the next couple of weeks, the global markets are going to be quite volatile, trading on technical factors. Any little, even body language from the US Fed chair is going to affect global markets at this time. So like you mentioned, oil prices are quite volatile. We saw dumping of risky assets such as oil. That has weighed on oil prices. We're also seeing recession fears, renewed recession fears, which were worsened by the US banking crisis, as well as the spillover in Europe and the US benchmark interest rate hike. All of those as renewed recession fears, which is weighing on oil prices at the moment. We also saw an unexpected build-up in US crude stockpiles, which shows that supply is quite huge compared to demand. So all of these factors are what's driving oil prices at the moment. But I think going forward, I think oil prices are going to be very, very volatile, trade very, very volatile, reacting to news about China's growth, news about the US Fed interest, the path of interest rate, as well as news about recession fears. Those are the factors that are going to drive oil prices going forward.
With all of that news we're expecting, I'm wondering where the bottom is going to be. At some point, are we going to see Brent at maybe $50 and WTI, with the way things are going?
It's hard to tell. Like 2 weeks ago, no one knew SWV was going to fail, right? And even oil bull like Goldman Sachs, who was forecasting $100 oil this year, now revised down what they are forecast to, I think, about $94 per barrel. So I think it's no one knows, all bets are off at this moment. There's a lot of fear, particularly amongst regional, small and medium-sized regional banks. There's a lot of fear that maybe this contagion, and maybe we're going to see some contagion. And the US Fed is trying to inspire confidence that what the FDIC is doing is work. Your deposits are was protected. They're trying to assure the depositors that their deposits are protected. On the other hand, yesterday the Fed Secretary Janet Yellen said that we cannot provide blanket protection to all depositors. So there's all of these factors driving sentiment and also driving oil prices. So I think it's very difficult to say what the bottom will be. We don't think oil prices will go as low as $50 per barrel, all things considered. But you never know, right? You never know. So
you never know. You never know. Just like we didn't know when it hit the high, that it hit last year. But what's happening with domestic commodity prices?
So domestic commodity prices, Ladi, they are mixed at the moment. Two big factors driving domestic commodities prices. So for commodities that have a longer shelf life, like we are seeing the prices of those commodities trend upwards. We are seeing, for instance, Gari is up 25% to 20,000 naira. We're seeing beans is up 33% to 56,000 naira. For other ones, the shorter shelf life, we are seeing them down because of naira scarcity. For instance, pepper is down 12% to 15,000 naira. Onions also down 9% to 32,000 naira. Now, in addition to all of this, Ladia, Ramadan starts today, I believe. So there's also going to be huge demand for some of these domestic commodities, as 50%, around 50% of the population is Muslim, and they engage in this mandatory fast. So this religious, religious fast. So that's going to increase domestic demand for domestic commodities. But on the other hand, Ladi, where many of these commodities are grown, in the rural areas where these commodities are grown, it is cash based. So the cash scarcity has actually affected planting, because these people do not have cash to buy the input for their planting. They are planting less. So planting less means that the harvest is going to be smaller. Harvest being smaller means that there's going to be shortage of some of these commodities in the market. And with some huge additional demand from the Ramadan fast, we'll see it's difficult to see where prices will go. But I think there's going to be some shortages of some of these commodities.
All right, we'll keep watching out for all of that. Thank you so much, Dr. Desola Sumoni, Senior Analyst, Financial Derivatives Company. Thank you so much.
Thank you for having me, Ladi.
All right, we'll take a moment now.